Welcome, everyone. Welcome, welcome. We are so excited to have you here. And we've got your attention, hopefully your time and attention for about the next 58 minutes. My name's Lynn Makela. We're going to jump in with some quick intros, and I'm going to get you acquainted with Kristi and Melissa, who are here to dazzle us with more financing information today. But first, let's start off with a quick poll, just trying to get a sense of where everyone is at within their financing or maybe their investing journey. Looking to understand how quickly you are looking, or if you are looking to secure financing for a new project in the next 6 months, or if this is more education for you to be thinking about as you're planning your next deal. So just kind of getting a sense of how everyone is in the timeline of things. Cool. Thanks for answering. Looks like we've got a couple of us looking in the not too distant future. Excellent. This will be very helpful content for everyone today. Awesome. Okay. Well, let's dive right in. Let's do some quick intros and then talk about those financing deals. Quick note on the poll. We do have, looks like a good number of you looking for information within to finance your deals within the next 6 months. So that is excellent to know. We'll kind of talk to that as we move through the content today. Great. So moving right along. Kristi, let's hear from you.
All right. So, hey, everyone, I'm Kristi Kandel, and I grew up in a small town in Ohio, and I accidentally fell into real estate development. My first job out of college, I had moved to Florida. I wanted to live on the hot, humid beaches and ended up getting a job at a sign company who was putting up the signs for CVS Pharmacy for all their new locations. So I accidentally got to see who the developers were, who were forming these communities, who the contractors were building it. And one day I was like, wait, how do I be a developer? And so I just asked one of the developers, I was like, what does it take? It seems so big and scary. And as a sign person, I'm the low man on the totem pole. And they told me, they're like, well, for us, we're a smaller company. And if you have the right, if you have the right attitude, if you're going to learn quickly, then you can be a developer and we'll teach you the ropes. So I, grew up in a small town in Ohio. All of a sudden, I'm working for developers, building things like CVS Pharmacy, Family Dollar, Chase Bank, and really getting a crash course in how our communities were formed. And I was able to then expand my career by moving to Southern California, where we were building 30 Family Dollars a year from San Francisco down to San Diego. So once the guys got the deals under contract, I was able to then take those and work with the architects and engineers and do the due diligence, entitlements, permitting, and construction management. So got a crash course on that, worked with another developer in California. We did 5 to 30 acre projects, and those were industrial, mixed use, residential, so the works. And I realized in 2015 that it was time to start making my dreams come true. And that's when I started my development and consulting company. So for the past 10 years, I've had that, and we've worked on projects nationwide. And a year ago, that's when we decided, hey, there's a gap in our industry. We have our smaller, medium-sized communities where we need people to come in and be the developers. And since the '08 crash, nobody has come. The professional developers have focused on the primary markets and maybe some secondary markets, but our communities have been left behind. And there's honestly no one more positioned better than the local people to redevelop your communities. So we created this company for local real estate developers and courses. We have a community launching at some point in September. So that way everyone can be a part of that. And we just really want to help give exposure and get experience to people out there so that way you can be the ones transforming your communities. So 20 years of experience. I've managed hundreds of development projects, and I can't wait to share our insights and strategies with you guys. And today's the financial side of it. So looking forward to getting into this.
Thank you, Kristi. And it's always a tough act to follow after Kristi gives that introduction and all of that experience. But I am Lynn Makela. I am what you might call a local real estate developer that is emerging. I'm working on my second development deal right now. And prior to that, I was in marketing for a technical career for about 20 years, and then decided that I didn't want to have a W-2 job. I wanted to figure out how to make money on my own terms. And so started in real estate investing, then ended up becoming a local real estate developer. And I also own 2 hospitality businesses. So at different webinars at different times, we talk about how all those things make sense in my life. And if you guys have questions, I'm happy to chat. But yeah, I'm going to hand it over to our guest of honor today, Melissa. And let's hear from Melissa and all of her excellent experience.
Thank you. Thank you. So, my name is Melissa Korda, and I am from the Seattle area. I actually was born and raised here, traveled all over, but ended up, back here raising kids again. I live probably 10 minutes from my family home. Couldn't get closer. So, love the area, but I also have similar backgrounds where I have a master's degree in kinesiology and was completely in a different world prior to COVID. Then COVID hit, became a stay-at-home mom after 20 years as a professional, and decided that doesn't work either. And a friend of mine was like, the lender you just used on a deal, they're hiring. And I was like, I'll take anything. It was remote, and I was desperate, just wanting to do something other than sit at home with my kids for COVID. And 3.5 years later, I'm still here and I love it. I'm no longer a flipper because I get to flip with everyone else now. But I do private money lending and I have rental holds. That's something we just kept as along the way. But I've been with Conventus for about 3 years and really enjoy the deal prospecting and kind of like working in this partnership with people. It's more fun to me. I always say I'm not really a salesperson. I'm a problem solver. Because I really like I've never really been in sales until I got into this career, but I don't see it as sales because I really like I obviously have something to help people and a value to sell, but more of what I love and why I enjoy doing these calls and like helping is because I get to do the relationship stuff and I get to have that little exposure to your deals and kind of what you guys are doing. So I feel like I'm still flipping and part of real estate. So, but I'm excited to be here and excited to help, and I'm looking forward to just all the communication and kind of hearing about everyone's deals.
Thank you, Melissa. This is going to be such a fun day, and thank you all for joining us. Just a quick overview of what we're going to talk about and a little bit of housekeeping. You are more than welcome at any time to drop questions within the chat. We'll do our best to see those and respond as we can, as well as highlight those as we go. So if there's something that you're like, wow, I really would like to know more about that, just drop that in the chat and we'll work that into the conversation. But generally today, we're going to talk about 3 basic areas, kind of the financing basics, which Kristi's going to take over and talk about. And then we're going to dive into some advanced strategies and some creative financing solutions with Melissa's help. So looking very much forward to the next 50-ish minutes, and we're going to save a few minutes at the end for more Q&A. So excited to dive in. Awesome. Kristi, take us away.
Well, thanks, Lynn. All right, guys. So one of the biggest questions that people have when you start your deals is, how am I going to fund it? I don't have all this money in my bank account. I don't know how to put this together. I hear the term capital stack thrown around, and I feel like that's a really big word that I don't know, and it goes phew. And so I'm just going to stay and I'm going to stick to buying single family homes. So we want to kind of take the curtain back and just give you guys some more insights around how deals are put together, and then get the guru to tell us more about how the lender sees things in the market. So I'm going to go through real quick the types of debt that you can have. So most of us are familiar with the institutional debt. That's when you're going to the banks. That's when you're getting the loans, whether it's to buy an asset. So whether it's to buy the property, whether it's an equipment loan. So if say you're going to run the restaurant that you're building and you need equipment for it, you can get loans for that. And that's a traditional process where you go to the bank and you get a loan. There's other ways though that you can secure money for the properties. And some of those are you can get private debt. So there's money lenders out there who have their money and they want to lend it to you. So they're underwriting you as the person along with the project, and you can skip the whole bank process in general. So that's one strategy if you want to skip that part. There's also peer-to-peer lending. So there's groups out there who can who pull their money in a fund and then they lend it that way. It's a little bit different than private money lending. And then a fun one that has been thrown out a lot more now that interest rates have spiked and people are starting to get familiar with it is seller financing. And a lot of times in real estate development, you're going to see that you're going to have a combination of that institutional debt and seller financing as part of your debt that you're bringing in, along with other creative ways that you can bring in and get your own personal debt. So that way you don't have to give up as much equity in your deals. So that capital stack, what that just means is you're just putting in all the layers that make the deal end up working. So when it comes to your personal debt, one of the really cool things that you can do is that you can tap into your existing assets. So you don't need to just have cash in the bank. You might say, I've got $10,000 in the bank. That's never going to do a development deal. But let's start to think about different ways that you might have some money and access to money. One is real estate investors that we're very familiar with is the HELOC, where you can tap into the equity on other properties you own, whether you take a line of credit or you get an actual loan. We do put on here credit cards. I would say be very, very careful, because if you do a 0% credit card and don't pay it off in time, the rates are crazy high. So be very, very cautious when you use credit cards. But if you have a 0% card, that might be a good way to fund the soft cost of your deal. So whether it's paying an architect until you get your construction loan, maybe paying some city permitting fees, maybe paying for some environmental reports, you could use that. Just again, use caution when you have credit cards. Another interesting one is getting security-backed lending. So say you have 100 grand worth of stocks out there, you don't have to sell the stocks to then fund your deal. You can take a loan out against your stocks. They continue to make money. Just like how you have a HELOC, your house continues to appreciate. You're just using that equity that you've built. So stocks work the same way. And then also one of my favorite strategies is the infinite banking and whole life policies, where you can become your own bank. So there's just all sorts of strategies that are out there. So don't just think about it as cash in your bank account, but think about the different ways you could tap into money that you have. And next up is the equity component. So this is where are you going to get that cash to then fund the portion of the deal that you can't get debt for? There's a couple of key ways, and they can get more nuanced, but friends and family are always going to be your number one. They're the people who have known you the longest. They know, like, and trust you. And that is why it's key when you guys are getting into real estate, whether it's rental properties or once you get into development. Share your story, talk to the people in your network, make them aware of what you're doing, because a lot of people just don't even think about it. And then when they hear that someone else is willing to take the risk, they're like, well, I've got this money sitting here. I don't want to do the work, or I don't have the time, or it's too scary, but I see that you're successful and I want to invest in you and this project. So don't underestimate that, because that can be your most powerful network. Joint venture is another way to go, which is really, really good for first-time developers. If you partner with someone like, say, a general contractor, then you can split up the roles and responsibilities. And then with the contractor, maybe they end up building your project at cost. And instead of taking their profit on there, they then put that into equity. So now you've taken your total project cost down, and you have the buy-in from your contractor, who wants this project to be profitable. They want it to be good. They're going to control that schedule and timeline even tighter than they would have normally. So JV ventures are a huge one that can help keep your costs down. It helps you actually get debt in some cases, because they see that the lender sees that you have a strong team and that the whole team is invested in the outcome of the deal. So it all ties together. You can also have limited partners. We've got people on the West Coast where sometimes we've got lots of friends who are in high paid jobs and they have lots of money and no time. So sometimes deals like that work really well when you can have people who go, look, I've got this money, you've got that project, I trust you, let's go. And then syndications are another one. I tend to shy away from those, because with a syndication, when you're talking development, you've got your development company is a company in itself. The operations of that business is a company. And then the syndication, with you keeping your partners and everyone who's invested up to speed, updated, you're checking all the boxes legally, that's a whole nother company in itself. So I wouldn't recommend that for your first one, but those are the options that you have. And then we have a couple other here where you can use your self-directed IRA, which is a huge one. I was explaining to someone earlier, if you are self-employed, there are so many ways that you can max out your retirement and then leverage other things to put as much money in as possible. And then you can self-direct that into other ways. So being a business owner and being a real estate developer, there's just so many benefits layered on top. That one's a little more complex, but totally viable. And then sweat equity. You guys are all willing to roll up your sleeves and put in the work. That means that you can put sweat equity into a project and maybe not even bring cash at all. So just lots of ways that you can bring money and to the deal. And then, so once you get through all of that, what you're going to find out is that part of your capital stack, you've got it filled up, but you've got this little gap at the top. And part of that is then going to be like, okay, I'm $1 million short on my deal. How do I make this work? That's where your network and communicating with your city officials, your county members, your state members, and you start talking to them and saying, hey, I want to do this deal in your town. Here's where we're at. We're $1 million short on the project. And that's when your city can start to get creative. They can tell you about the tax abatements that are out there. Maybe you've got some contamination and they can help you qualify for a brownfield grant. There's so many other grants and things that are available. So build the relationships within your local community, and it might take some time. We just had someone the other day who told us after 6 or 7 months that the city thinks they might have $700,000 now to put into their deal where they're turning a mobile home park into an apartment complex. So the money is there. It's just tell everyone in your network about it. And eventually you'll be able to put that whole capital stack together to where the returns make sense for everyone. And then this goes on, there's some more federal grants and incentives. One thing I'll say to the federal part is those are more complex. They have more strings attached. They're not going to move as fast. So if you can stick to your local city, your state, and your county agencies, those are going to be the lower hanging fruit that get your first and early deals through. The federal ones and other incentives are completely viable. They just take more effort and regulation to make happen. And this just goes into some other types of private funds, but that is the general overview. So let's go ahead and Lynn, I guess that you're up.
Yeah, we'll do this poll real quick and then I'll tell you a short story about financing. What type of financing have you primarily used for your real estate investments? So if you have gone down this road before, where have you sought financing in the past? Conventional loans, hard money loans, private lender loans, or debt service coverage ratio, DSCR loans. We like our acronyms. I'm thinking about the last deal that we just got under contract on the development project in the last month. And it was fun to hear Kristi go through all of those things because we have literally used almost every one that she mentioned in there. So we were able to secure some seller financing, which we were actually able to negotiate up as part of the due diligence process when we found some other things on the property. The seller was willing to offer an additional note to us to take it over. We also did a limited partnership. So we brought in an outside investor. We also did conventional financing. So that's already 3 layers on top of that. And that was to close the deal. And now we've already secured 1 local grant, a facade grant for our development group. And we're going to do some regional financing. And that's all, we've been working on this deal now in total for almost 9 months, but we only closed on the property in July. So it's a lot of moving pieces, especially when you're dealing with larger deals. And I guess large is kind of relative to where you are in the world. But in my mind, in my area, $1 million plus is a larger deal, not probably relevant to Kristi and Melissa and maybe where some of you are in California. But we were able to use all of those methods to appropriately secure that money and to begin renovating the property. Cool. So
you made a good point there real quick, because you said you've been at this for 9 months. And a lot of times we get the question of, can we do this on the side? 100% you guys can do this on the side while you're still working your W-2. So because a development project will take you 1 to 3 years to get online to start bringing in revenue streams. And while it's a lot of steps, they're spread out over a longer period of time. So it's not like you're going to need 40 hours a week to work on that project. Some days are going to be more intense than others. Some weeks will be. And then you'll just be sitting around waiting sometimes for weeks to get permit plan checks back or to finish the funding and to close on the loan. So this is 100% something you can do on the side. And it's as easy as starting with just building the relationships with everyone in your community.
Absolutely. Excellent. We've got a couple of answers. Most of us are familiar with conventional loans and a little bit of experience with hard money loans. So with that, we're going to tee up the ball for Melissa and have you take us away through some of these lending options.
Okay, cool. So I'm looking at the polls and it looks like most people have been using conventional or hard money. So that's great because that's part of what I talk about. Okay, so lending options. There's a lot, but there's 6 basic groups. Conventional, I always, as a lender, we only do hard money. But as a person who's in real estate and investing, the best route is conventional. Like you really do get the best rates. The problem is sorry, when my dogs hear me talk, they think they can talk too. So they'll realize no one's talking to them and they'll stop. So um but they do generally give the best rates. The hard thing with conventional is you tap out of your debt to income ratio. So eventually you just can't use conventional anymore. Or with real estate, the rates are a little bit higher and then it takes a long time to close those because they look at income and they look at there's a diligence process. So it's not always effective when you're trying to get like a quick deal done. But if you can, I always encourage people to like utilize as much conventional as they can. And then cash always is, it's a great option if you have cash. But again, you lock up all your money. And is that really, like your end plan to have everything free and clear, but no liquidity to do anything more to scale or grow? So I think a balance of all different lending types is really positive. But again, whatever your exit plan is or your long-term goals, that's where your lending should really kind of be directed. Another great avenue is private lending. So the difference, like a lot of people are like, are you bridge lender, private lender, direct lender? And there's so many terms for all of us. Private lending is different than hard money lender. Hard money lenders are still institutionalized in a sense. We still have guidelines to follow. If we do DSCR, we're definitely governed by like governmental guidelines with those. But we have more control because they're private institutions owned by a group or a person. And in our case, we have a CEO that controls our investment group that kind of runs our fund. So there's more control. We can do more things, but we still have a lot of boundaries. And then where private lending is super flexible. So I have like a really good buddy that she does private. And if I can't do a deal, like say it's a mobile home parks, we don't do those. I refer to her because she can get them done, but she charges a lot more. She has less restrictions. And she basically is like, I like you. I like the deal. I don't care that your FICO's this. Like, I'm feeling the vibe. I'll fund you. And that's where private lenders come in and they're awesome because they'll come in clutch. They'll help with, gap lending, down payments. There's definitely they should stop. I'm sorry. Okay, so then those are so I always like to touch on that because I don't want people to think like I'm the only type of lending for investing, even though like it's what I do and we are a great aspect of investing. So I always try to like make sure there's other avenues, definitely like ask questions about those. But what we do great and what hard money is really good for is your bridge, your transactional, your fix and flip, your ground up construction. And then hard money can also be a DSCR loan, and that's your long-term hold loan. So it doesn't, people are always like, oh, I thought hard money was just a quick loan. They actually can be a long-term loan. And the biggest difference with hard money is we don't ask for income. We don't care if you work. Most of my clients don't have real jobs. They're just investors. So that's kind of like a good sign of success is when you can give up that W-2 and just go into investing. So we don't want to punish you for that. So no income, no paperwork, fast out the door, but we can do it long-term too. So that's a really good benefit. So moving on, the first one I'll talk about is the bridge loan, the short-term loan. I listed here the kind of deals that go into this. So this is your typical 12-month deal. It's an interest-only loan. It's quick. There's no penalty to get out. So If you think you can do a flip in 3 months, this is a perfect loan because you're probably only going to pay holding fees for 2 months because you don't pay anything the first month, and then you get out as quickly as you can, either sell it or refinance. There's with these loans too, we also cover the rehab component of it. So the construction component, the budget, and that's something that, again, going conventional, they won't do that. So if that's what you need, like this is where bridge loan lending or hard money lending comes in, it helps. But we do fix and flips. Bridge loans are great for rate term refinances. So say you did your flip and it's all done and it hasn't sold yet and you're running out of time, you can refinance that portion that you owe, get another bridge loan for another year, and then continue your plan to sell. And eventually, if you can't sell, maybe new plan and hold as a DSCR. We do cash out refinances. Say you've had a property for a long time, it's got equity, you want to buy something new. We can do a short-term cash out. Delayed purchases are something that a lot of people don't know about that are really great. I think I got off my Zoom. Okay. I gotta be careful. I have the presentation on too, so I was not on it. Okay. So delayed purchases are actually something that people should use more. So say you have this deal that you have to grab this property and if they want a 5-day close in cash, but you really don't want to give $200,000 in cash to be locked up on this deal. Many of my clients will pay cash, then come to me for a delayed close. And then basically we just start the loan, close it like a regular purchase. And then when we close, they get their cash back and our loan is put into place. So they didn't have to deal with a closing, but delaying a purchase or maybe not winning a deal because they couldn't show the seller that they can close fast enough. But they also get their financing in place. And there's no penalties, there's no extra fees to do a delayed purchase. It actually makes things less stressful because we're not up against all the seller agents and the sellers and everyone going close, close, close. We can just, you're already closed, it's owned, and we're just putting a loan in place to give you your money back. And we can add that rehab at the time. So now you have funding to do your deal. So delayed purchasing is actually a really useful tool to win deals and to not be tied up or contingent on lending if we'll close in time, because that is like the number one question, like how fast can you close? Renovations, constructions, that's our bread and butter. Most hard money deals, that's why we're here, is we will fund a crappy project, a crappy property, do your add value and make it amazing. That's what we love doing because that's where, the most returns are seen. Ground up and mid construction is huge right now. I think everybody bought land during COVID because it was so cheap and there was nothing else to do during that time. And so now everyone is ready to build. So it's kind of cool because we need housing across America. We need housing. So it's kind of neat that now land is getting built on. And for the most part, everyone is really working towards affordable housing because that's what half America needs is affordable housing. So ground up mid construction is huge. But we do tons of that. And then transactional is just the key term of you just got to grab this property fast. You need to do this quickly. Something's maturing and it has to get closed fast and out of a loan it was in. Hard money, bridge loans are all good for that. But again, it's short term. It's not a long term thing. You always have to have an exit plan. Oh, okay. Perfect. I was like, how do I change pages? Okay, I think I talked about some of this stuff. So why bridge loans why use them versus conventional? Again, we talked about the income stuff, if that kind of disqualifies you or DTI, but biggest things is it's fast closing. Most lending also doesn't do the rehab. So this is another way to get that rehab funded for you. And then when you do a conventional or you do a DSCR loan, it has to appraise and it has to appraise with no issues. I remember I did a refinance on a rental property and there is 2 steps out the back door that no one needs a rail. My old grandma who needs a cane to walk can walk down these 2 steps down the back door with no rail, but the appraiser would not pass my property until a rail was added. And it literally was like 2 pieces of wood nailed to nothing. And all I did was had a contractor come and send $200 to add it, take a picture, send it to the appraiser, and then I cleared. It's very annoying. But that was minor and they wouldn't clear it. So imagine if there was like something bigger that needed to be done, you would not be able to close on a deal through conventional or DSCR. So this allows you to close on non-lendable properties. So we're closing on things with fire damage, things that the roof is not there anymore, things that are completely inhabitable. A lot of properties we do, maybe they started rehab, so they're down to the studs. Those would never go through traditional financing, but we'll fund them because we see all the add value there. And again, no income verification. Important keys. So I always do these kind of out of order. I just get flowing. Sorry, I got to be better about PowerPoints. Big things on bridge loans, investment loans, no personal residences. Back when I started, we used to let you cash out of your personal residence and use that to do like a rental property. But now our company in particular, and I think a lot because I get a lot of inquiries about it, we're not allowing that anymore. They really want investment money to just be connected to investment properties. So they're kind of everything against a personal residence. No one's really doing investment stuff on those. The big thing about bridge loans is you're going to pay higher rates. So when you think about bank long-term rates, we're all, in the sixes and excited, right? Hard money loans are more in the tens. So anywhere from 8.99 to 11.99, depending on what you're doing. If you're building or doing big construction, plan on it being closer to 11 and 12%. But again, it's short term. So these are just 12 months or less. This is not a long-term solution. So when you do your deals, you really want to diligence the price to hold the loan, how long the rehab is going to take, what rate you're paying, and there's no income to this property till it's done. So can you sustain that? Because every good purchase price and good ad value, ARV, is not always a good deal if all the holding costs are way expensive to get you through that project. So know upfront that bridge loans are higher rates for sure. They're always interest only because there's really no pay on the principal. And then for most companies, we do no interest on the rehab until you use it. So when you do diligence or look at lenders, make sure you ask that question, because I've gotten some term sheets where they're great rates, but they're paying interest day one. So say I give you $100,000 for rehab, you're not paying interest on that with me until you actually use it. But other companies are charging you $100,000 interest from the jump. So not only what we paid on that property, but also on the rehab. And that can be a lot of money, especially when we're doing like a $2 million deal in California, adding like $300 of rehab, like that, or 300,000 in rehab. That is a lot of interest at 10%. So always make sure of that. These are between 12 and 24 months. And I have standard is 12, but we have 24 because some of the construction projects, like Kristi was talking about, take a long time, permitting, all that stuff. So if we can plan ahead enough to know, we'll have it start at 12 months. But again, don't stress, because if we get to the end and it's like there's no way we're going to be done, most lenders will let you refi for another term. They'll do extensions. There's lots of options. Like no one's going to come knocking on your door for $500,000 balloon payment now, or we're taking the cat. They will work with you, but we definitely want to plan ahead. So as much as we can know about timeline of the project, it's really good. Credit impacts. So most lenders, I hear a lot, people don't do hard pulls. I don't know if that's true or not. We do. We do one hard pull, and the bottom line is we're giving you money. We want to know you pay your bills. Like that's just it. We do it once, and we do it once a year. So if you repeat with us, we don't just keep pulling it, infecting your credit. We do it once per year. And it doesn't affect your DTI. It doesn't go against your personal. It won't show up on your credit report, but we do check it. And if you have lates in mortgages, we're not going to lend to you. Most lenders wouldn't, because where you live and your home is the most important thing. And if you don't pay that bill, you probably aren't going to pay our bill. So it's really important to protect your credit and make sure that you do pay bills on time. And if you have to pick and choose, pay your car and your home bill first, because that's heavily looked at on the scales for us. On all of these, every deal that gets closed with a bridge or a DSCR has to have a value report. There's lots of options for that. There are some mistakes made where people come to us and say, I was with another lender. I paid for a report. They won't close with me. Can you use my report? And we can't. Most lenders will have to pull their own report. It has to be third party. It can't be influenced. We can't pick who it is. We just have to say this place needs valued, give us a third party report, and we use that. If we're tight on time, we have options to do broker opinion reports, which are a little bit faster and they're cheaper. We can also do drive-bys, especially if we're working on like auctions or foreclosures where we can't get into them. But at some point, we need some kind of value report that says this is worth something and there's actually a structure there, or it's just land. You'd be surprised how many times people want to buy something and they're like, it's a single family residence. And we look at it and we're like, there's not a structure on this entire property. So value reports are really important. They have to be done, but there is some things that people need to be aware of when we do them, and try not to pay for tons of reports because they're useless until you find the lender that is actually going to fund your deal. And then with all of this, I always talk about the BRRRR process because the bridge loan is kind of the start of that BRRRR process. It's buying your property, rehabbing it, and working on that. Oh, back to Lynn.
Awesome. Before we jump into the poll, I wanted, is it okay to pause for a quick question, Melissa? Or you might be covering this, so you can push this one off.
Oh, I forgot questions. Yeah.
Yeah, oh, no worries. We have a question about mezzanine financing from Yishi, who's coming from the private lender side, and this is his sole focus. Given the current environment, seeing interesting opportunities where developers have sufficient net worth but are illiquid and are willing to put up personal guarantee collateral outside of the development project. Have you had, or could you speak to any of those? And I know Kristi had a follow-on question, just linking from the lender's perspective and then the risk. So just curious if you've got any mezzanine equity and loan experience, Melissa, that you could help speak to that.
Yeah, so many times we'll do like, it's similar to like our cross collateralization programs where the properties have to be free and clear, but we definitely will take, especially builders too, because a lot of they take nothing to make it something. So there's not a lot of value in what they're actually building on yet. So we will do cross collateralization on other properties and use that for like down payments or parts of like startup funds. But again, it has to be free and clear, and similar to like what we lend in residential. Somebody once asked, they're like, we own a gas station. Can that be one of the properties? And unfortunately, no. And then also times like we have people that cover some of their deficits with private lending. So we'll allow I say this loosely, we don't allow private lending to be on our loans. We don't allow seconds, but many of my clients will work out private lending deals outside of us. So they're basically creating funds on their own, and as long as they close with the funds through the borrower's accounts, whoever they are, like whoever's part of the LLC, we don't season any of our funds. So I don't want to say we don't care where they come from, but we don't check because many of our clients have different bank accounts and are always moving money. I hope that answered the question.
Yeah, thank you. Well, I can't speak for Yishi, but just trying to think about it more generally from a broader perspective on both sides. I love that.
Yeah.
We were also trying to figure this out with our current development deal, just in terms of we had a high net worth individual, but was pretty illiquid. He brought some money to the deal, and we were trying to evaluate how best to go through those hoops of being approved, of having that, like going through his first commercial real estate deal was new for him. And so we were working through some of those details of how to best leverage the known experience of our group plus his equity investment. And yeah, it's always, there's so many ways to think about it.
There are, and like the best thing I get, like some people will call and give me like they'll tell me a few things, and I'm like, I almost have to like dig. And what I would advise is like lay out your story and like lay out the players. Like this is who's involved. This is what their situation is. Because in that situation, in those, when I can see it all, I can go, okay, this guy, we want to remove him or drop him to 19% because his FICO's crap, but we need his liquidity. Or this one has great experience and like he doesn't have to sign if he's under 19. There's lots of maneuvering, but if I only see the good stuff and don't know about the bad, and then we're in the deal, and then you throw in a guy with like 540, and I'm like, oh gosh, what do we do? It makes it just harder. So I would say, and that's one thing I do talk about, is one thing from a lender is our job is to close a deal. So we're going to try to get through all the hoops. Like we don't want to be gatekeepers. Like I don't get paid unless I close loans. So I want to know all the issues so then I can like work through them. So if the more transparency you have with the lender, it's better, because if it's a negative, it's going to come out eventually. So let's get it on the table first. We'll see how we can maneuver around it. And like I said, if we can't, I can always help find a different spot, because I do have other people in lending. And I think that's what I always encourage people to find, whether it's me or somebody, to find a relationship with a lender that will be honest with you, that you can be honest with, and then really can find some solutions, and is okay saying, I can't make this happen, but I trust them and they could help you. I think that's most important, because a lot of people don't want to, it's like dating. You don't want to tell all the craziness, up but it comes out and it either going to ruin the relationship or you work through it and it's an issue. But if it comes out at the front, like it just makes it so much smoother. Because again, we only have to 2 weeks sometimes to get close.
100%. It's the same thing with lenders or doing initial due diligence on a project with the city to see what's allowed. You want to put all the cards on the table early so that way you can see, okay, can this even work? Because the city, your lenders, everyone wants to be your partner in this. And the earlier you bring it up, the more everything you disclose, the more you can work together to come up with a solution that actually will work. And that's just why it's also lender has a different threshold and different portfolio and different ability to lend on certain things. So that's why it's so important to build those relationships early with your strategic partners. So that way you have a roster of them to where if it's like, if Melissa's like, oh, this doesn't work in mine, but it works in so-and-so's, or maybe it doesn't work in that person and they don't recommend someone else, but you can go to the other people in your network and be like, hey, here's the deal. Will it work for you? So relationships, networking, have a deep roster, all of that.
For sure. And a lot of times, as much as like we're in lending, so there's a lot of like, we have lots of regulations to follow, but there's a lot of gray area. And the best investors are crossing that gray line as much as they possibly can legally. And I don't say I encourage it, but I definitely know some ins and outs of like, it's okay. Like everyone does that. Like, don't tell that to somebody. Don't repeat that one. Please don't put that in writing. There's lots of things that like, especially new borrowers, they're, everything's new. And so I think it's really good to have those calls and just disclose all of it, because then whether you work with me or not, you can get some direction on what to say, what not to say, what questions to ask. Because that's half the battle, is just learning the game. This is all a game. And it's just a matter of who plays it the best, who makes the most returns.
Yep.
Awesome. Thank you. Thank you, Melissa. I think we closed the poll just a smidge early. Sorry, guys. But essentially, did have some folks that were interested in the loan approval process as a challenge to securing financing, kind of a concerning side, and then documentation requirements. So we'll take those notes and kind of move into the last part here, where Melissa is going to take a deeper dive, and then we'll open it up for more Q&A. Oh, look, and you answered my question that I had that I didn't even ask yet. Oh, I love learning. Thanks, Melissa.
You're welcome. Okay, so the second part of so we really do just 2 types of loans. The bridge side, which is tons of different things in there, but then the long-term side, which is our debt service coverage ratio. So if you think about yourself and as a personal borrower, we talk about DTI, so your debt to income ratio, where it takes all your debt, everything you've ever done as a family, as a person, and it's that debt to your income in a ratio. And if you're married, it's both your incomes, all of that combined. With real estate, they created this so it's every property for itself. So that way it doesn't affect, you can do great on one property and terrible on another, and it doesn't affect all of that. So you can still get lending, properties can still be wonderful, and it's not affecting your personal, it's not affecting all your deals, it's just one deal at a time. So with this, these loans are for long term, they're stabilized, so they've been flipped and rehabbed, they're rentable or they have renters in them, they're rent ready, they're brand new construction. The term turnkey is the one that's really connected with this, but they can't be need rehab. They can't need help. They can't not pass an appraisal. But this is your long-term loan. And this is very similar to a personal conventional loan, generally a 30-year. There's always options for 5 and 7-year ARMs. There's options for interest only for 10 years, but this is your long-term loan. Now, this is dependent on the debt service coverage is dependent on how much the loan is going to be, what the rents are that are coming in, what the insurance is, what the HOA fee is, and what the taxes are. So with those 4 things, it creates this ratio. And if the ratio is over a certain point, you get better rates. So for us, it's over 1.2, you get the best rate. Debt service ratio 1 to 1.19, you get a good rate. And then debt service ratio 0.8 to 1 is not great rates and it's kind of terrible, but it's really good for short-term rental, because the rents we use have to be market rents. So it really makes it hard for a short-term rental to show on paper that it makes a ton of money. But usually short-term rentals are like 3 or 4 times market rents for a single family rental. So it's okay to have a low DSCR on those because you're making so much returns in your income return. So there's some strategy with using that, but basically these loans are set up to, we'll fund them it's like a conventional loan, but you don't have income, you don't have docs, it's still hard money, doesn't affect your credit, doesn't go on your personal. But they have to show that they are revenue producing and that they will sustain through good and bad times. So that's why there's a ratio to kind of have a range. These are frustrating for people because you could have rents in place of $3,500 a month. But when the appraiser comes back and the market rent says it's $2,900 a month, that's what's used for your DSCR ratio. And that's basically because the market, we want to lend when the market's at its worst. Even though you're getting rents at 3,400, doesn't mean you're always going to be able to get that. If there's a crash or rent crisis or something. So they always look at the worst case scenario. So it drops their DSCR sometimes. So if you have good rent spread, it's okay. But sometimes if they're really tight, it really drops and then rates go up and down. The good thing about DSCR is over the last 3 years, I would say 3 years ago when I started, our rates were higher than banks. So we didn't really have a great product because go to a bank, spend 60 days, just it's a 30-year loan, like put the effort in and do that if you can. Even credit unions were doing real estate loans where you didn't have to do W-2s and qualify that way. Still better rates than we are. But now all the rates have dropped and our rates are really competitive. Most DSCR rates for us are between like 6.5 to 7.25, depending on the property type. And we're lending on single family and multifamily and mixed use. So it's really, really good. I just quoted somebody, I couldn't believe it, like 6.3 on a purchase at 80%. And that's really low for us right now. So yeah, so DSCR is great. And so like in this environment, once you build that property and say you're not selling it, it's brand new construction, roll that into a DSCR. And then that's like perfect for it because it's rent ready, it's stable, it'll be stabilized and it's beautiful. It'll pass an appraisal. So it's easy. Okay, my notes. These also could typically, so lending on these there is a prepay. So there's usually a standard prepays on these guys are 5 years and it's a step down. So the first year it's 5%, then 4, 3, 2, 1%. After 5 years, you can refinance it, you can sell it, no prepay. Usually at that point, people decide, do they want to sell? Are the rates better? Should I refinance? Should I take money out? The reason they do that is it's about 5 years to get more equity. So then values are up. So it makes more sense. But also you're getting that low rate. So banks want to lock you in and make sure that, if you get out early, there's some kind of compensation. You can buy down to a 3-year, same thing, step down, but it's just less time. So if you're like, I know I'm going to hold this for a while, but I just don't know for 5 years, then the buy down is not too bad either. I want to say it's like 3.3% more in rate to have it 3 years versus 5 years. So there's lots of flexibility. You can also buy down the rate. So say I quote you 6.5, you can buy down to 6% with a couple extra points, 1 or 2 points, depending on the loan and the area and stuff. So there's lots of options for better rates with these. You'll just pay for them up front. And the last thing I have is these payments are PITIA. So they're just like conventional. So it's principal, interest, taxes, insurance, and association fees. So your payment, most people are like, oh, I'll just pay taxes and insurance on my own. Most of these won't allow that. Similar to conventional, it's all going to be rolled in. There's going to be an escrow account. It'll all be connected. Again, these guys don't affect your personal credit. We will run your credit, but they won't show up. They don't go against your debt to income. With DSCR, so with bridge lending and construction and all that, it's really driven off of experience, FICO, leverage, and property. Experience is really big over there on your pricing, but over here, experience is not as big. It's really driven off FICO and leverage. So how much money we're taking out in that DSCR. So experience over on this side, we have a lot of, I think a lot of people think grabbing a rental that's great, that's just going to produce revenue and doesn't need a flip is an easy start for real estate. And in some theories, it might be. But we definitely allow like brand new or new borrowers to jump right into a DSCR loan because there's less risk. We're not worried that they're going to fail out of rehab or not know what's going to happen with a fix and flip. So we don't fund off of experience on those guys. These guys can be used for long-term and short-term rentals. They're part of the BRRRR process. So they're kind of the last part of the BRRRR process. The big thing on short-term rentals that I talked about with DSCR, and I know I lost people on it because it's a DSCR concept is bigger than a 10-minute explanation. But when you're doing the short-term rentals, most of the DSCRs will cap. So the max to get on a purchase is 80 or 75 on a refi. If it's a short-term rental, we're going to cap you at 60 to 70%. And again, because we have to use the market rents, and those market rents will not hold on a DSCR very much, because usually you're buying these beautiful properties where everybody wants to Airbnb, and it's not like the ratios just don't work. So they can be used for short-term rental, but there's a lot of like restrictions and kind of guidelines with those. So I definitely, when you're vetting lenders, make sure you talk to them about the restrictions for short term and kind of like what they use. There, I don't know a lender. I honestly, I know a lot of lenders. I don't know any lenders that do better than us on short term. It's just it's tough because I think the worry is short term rental might go away, and then people will be stuck with these long term properties that don't rent or hold for their loan amounts and their payments. So that's a tough one. Okay, borrowing power. We talked about that. Be accurate with the information in your business plan. I couldn't stress enough what Kristi and Lynn talked about with just relationship. Like this is money. This is your future. Like it's all going to be on the table because one, it will always come up. Your lender's going to do a background check. Your lender's going to pull your credit. They're going to look at your criminal history. They're going to see anything. They're going to see it all come up. So just be accurate, but be clear about the business plan. And even if your business plan is, I don't know, like I think I want to create an empire of Airbnbs, great. Or that's one idea, or lay out all 5 ideas because your lender should tell you, where are we focusing first? But at least, they understand that like you're not set in anything. So like good opportunities are going to come your way. Where I have people who are like, no way I'm flipping. That's not my thing. I just want to hold rentals. So just be clear about business plan and kind of like, or changes in your business plan. It always helps us because when I have people come to me and they're only landlords, but then they want to start buying these like dumpy projects in Detroit, I'm like, what's happening now? Like, what are we doing? And it's like, oh, my friend did this and she's doing it in Detroit. And I'm like, your friend lives in Detroit and she does flipping. Like that makes sense for her. Does this make sense for you? And then they'll say, no, it just sounded like a good idea. Or they'll say, yes, I'm going to move to Detroit and we're going to start an LLC and I'm going to do this too. And then it's like, okay, that makes sense. But again, like I want to make sure you succeed and I want to make sure you pay my loans. So I want to make sure we understand and we're on the same page. So I think it's important that you just have an open dialogue. Another thing that not a lot of new borrowers don't start with is the personal financial statement. And I actually have a simple one. I don't know if Kristi and Lynn do too. I send it out. It's just Excel, but it basically, you just track your real estate. You track what you're doing, what your exposure is, what your own properties are. And so when you're vetting lenders, you just send like, this is my personal financials. I know exactly who I'm dealing with, your experience, your FICO, your liquidity. It makes it easier to price you, but it also makes it like when we're collecting information, I don't have to say, okay, I need this now and I need this now. Like you kind of all have it in one spot. And then every lender wants the same stuff. So that way you don't have to just, oh, the lender has that form or they have this form. You just send them your form and we're good with that as long as it has all the information that we're asking for. So that's a really good thing to have, to be organized. The worst thing is when you send me an email, it's like, hey, I found a property. Here's the purchase price and the address. I'm like, cool, I need this information. And then you respond with 2 more of the questions. And I'm like, great, I still need this information. And then 20 emails later, we find out that the property is rural and there is no foundation left. And it's like, okay, this isn't going to work. So it helps with lending and with your response is if you're organized and get us everything at once, then we can get you a response back really fast. And then you don't waste time, we don't waste time, and we're just more productive. Borrower experience is important if you have it. And I'm surprised. I have some people that are like, I've got 20 projects in the last 3 years. I'm like, great, where's your sheet? And they're like, oh, let me fill it out. And I'm like, wow, 20 projects and you're not tracking this stuff. And everyone works differently, but every lender will ask you for an experience sheet. So if you're not tracking your experience, start tracking it. We want to know what you've sold in the last 3 years, what you're holding still. And you can go back 5 years, but mostly we want to know most want to just know last 3 years. And then FICO is power. I can't stress this more. It's how we price you with DSCR. It's how we price you with everything. It's honestly how we look at you as a person because we don't know you very well. So if we see your FICO is super low and you're late on everything, we're kind of quite, like the easiest thing is like, they're not consistent, they're not organized, they're not valuing bills or other people that lend money to them. That's just a real observation. It might not be true. You could have a situation, there could be anything. But if you really want to be in the best position for lending, best pricing, quickest turnaround, protect your FICO. Don't let people just run it to price you. We don't have to. I can give you a price on any FICO you give me. It won't be accurate if you're not accurate, but I can price you. I don't need to run that. You don't need to run a FICO to do an application. You don't need to pay for an application fee. Any good lender would just price you and want your business. So don't give that stuff away. That's like a social security number. Just keep it tight. Wait till you find the lender that you love. And again, I would say, like, try to stay with that lender because they won't be pulling your FICO all the time, and they won't be charging you points to drop your FICO every time they pull it. So FICO is really, really important. And I'm surprised how many successful investors don't protect it a little bit better. And I just encourage everyone. That's a big thing.
True story. Hey, we're coming up to the wire. So maybe
Oh.
Lynn, if you want to run through, and then we'll circle back with any final thoughts, Melissa, after this real quick.
Yeah, absolutely. And Cess, let's go move ahead to slide 24, please. We've got some great information that you guys are going to have here when we send this presentation out. So there's a little bit more for you to dive into on the other side. And Melissa and Kristi are going to be able to stay on and answer some questions. Unfortunately, I have to leave at 2, but we wanted to take a second to just share with you a little bit more about what we're doing. So as Kristi mentioned, we are in the process of creating educational resources and creating a community around local real estate development. And that all started with our small course that is kind of designed to make sure that you are ready for a development career. We have a lot of real estate investors. We have a lot of people that have done fix and flip. We have some that have done Airbnb, and they're all like, what does that move into development really like? And this course does exactly that. It lays out all of the details along with a vision sheet, some strategies for what you might think about doing this, paralleling a W-2 job, the whole development process, which is quite lengthy. And like I started to get into with some of my examples, it takes many years. So it's the long haul, but you're making extreme impact in your local communities. And as part of the Blueprint for Local Real Estate Development course, and because you're here today, we wanted to make you a super special offer on the next slide, where you can join this Blueprint course. If you do decide to join this course, it is a primer for a larger course, kind of the full soup to nuts, everything you need, including a community, including coaching. Say you've got a project in your local community that you're like, that is mine. I want to transfer that into something amazing. That course will help you do that. But the Blueprint course has all the starter pieces, checklists, workflows, examples, insights, tips, and some bonus materials as well. And because you're here today, we wanted to make sure that you guys had quick access. And Kristi just shared the code as well as the URL in the chat. But essentially, localrealestatedeveloper.com/course-sign up will get you 50% off. And if you use that QR code, you'll be taken directly to that page. Use the code on the next slide, which is LREDOG50. And you're able to do that for the next 7 days. So we are so excited to welcome you guys into the Blueprint course. Like we said, if you pay for that, that gets you the same credit on your larger entry into the advanced course. Again, we are so excited to be able to share what we've learned as well as take you through the process of local real estate development. And with that, I am going to hand it back over to Melissa and Kristi, who will go through some of the other questions that were asked, and then we'll talk through some of the other resources. But thank you all today. And yeah, we're gonna dive back in.
Awesome. Thanks, Lynn. Good deal. Looks like Melissa there, I think you answered in the chat, but it might be good to just bring it up and maybe expand a little bit on that for everyone.
Yeah, so the question was about DSCR and about income percent, base interest plus percent of. I don't quite understand the question, but I think you're leaning towards questioning when it's a multifamily. So anytime everything I kind of spoke on was more about SFR 1 to 4. Once it's 5+, it becomes multifamily. And at that point, lenders are now looking at not just value of property, but we're looking at rents, and ARV is based not just on value of property, it's based on rental productions as well. So in those cases, a lot more questions and diligence are asked about expenses and rents and metered, if each apartment it's metered or each unit it's metered. So there's much more into that, but I think that question is based on delving into more of the DSCR. But I hope Yishi and I can just do a call because I think he has some really specific questions. Um,
Yeah.
and then going,
And then
so
you
here
mentioned your PFS, the personal financial statement. If you had a
Yeah.
template, we can share that with the presentation to everyone who is on, because that is super helpful. I know different lenders that I have their forms, but guys, even if you have that core data, and so every 6 months I have a reminder come up for me to fill that up and bring it up to
Yeah.
speed again. So just having that, like she said, the biggest thing with all of this is be organized, have your stuff together with all your different businesses and things that you're doing, have your plan. The more organized you are, the less curveballs are going to come out of left field. So it's just you want to have all your ducks in a row, because there's so many moving pieces that the more you can have that, the more you can better adequately take those curveballs that come and mitigate your risk.
Yeah, absolutely. So I just dropped it in here. And again, if it doesn't, I think, let me keep
So,
trying as I talk.
okay.
But I'll they're dropping it here. I'll get it to you, Christine. You can get it
Yeah,
out.
perfect. And then it looks like Carmen was looking for the borrower experience template too.
Okay, let me work on that as I
So
finish up here.
and I'll follow up with you separately on those so we can
Okay.
get.
Yeah, and I have a scope of work template as well. They're simple, but it's easy. And that way you can, once you're doing those flips, it's what we want to see too. So you can see that as well. And then, so here, this is a simplistic form of the 3 types of intakes that we do a lot of. And it's basically when you're doing a bridge loan or ground up purchase, this is all the stuff I'm going to ask you. So if you can get this to me in an email, this makes it, I can price you in 30 minutes, like super quick, super easy. Then I did a little section on what for a refinance, a bridge or ground up refinance, and then the info that I need for a rental 30-year DSCR loan. So kind of the different questions we're going to ask, very much similar, but a little different based on the different loan types. When somebody emails and says, "Hey, like I got a deal, can I get pricing?" I respond back with this list, and it makes it super simple. So knowing this ahead of time, you can see how we diligence your deal and what we think about, so then it can help you when you're looking at your deals and kind of where this stuff plugs in.
Some. Cool. Yeah. And then guys, go through these real quick too.
I'll go really quick. Remember, we want your business. I don't make money unless I close deals. So you have the power. So biggest thing you need to make sure you're working with is a direct lender. Many people say they're a lender and they're usually a broker, or they're a white label lender, or they are a middleman basically. So there are direct lenders like us. There's a lot of really good direct lenders you can go to. And then there's people that bring you to us. And we work with brokers, but you're paying points to them and points to us. So eliminate all that, do your diligence, do your work, and go directly to a direct lender. Ask them straight up. It's like the police. They have to tell you, are you a direct lender or not? The reason you want to avoid that is because brokers are bringing you all over the place and they don't know much about where they're bringing you. They're bringing you the best pricing for them. So for example, I have a broker, I don't work with him anymore because of this, but I had the best pricing. I had the best situation for the borrower. I had the best everything. But because we cap them at 1 to 2 points, so they can't overcharge our borrowers, he didn't present my offer to the borrower because he wanted 3 points and we only charge 1, and we just don't allow brokers to do that. So my borrower got and I know this because the borrower reached out to me because she really wants to work with me, but I can't overstep my broker because they brought me. But she said that the best offer he gave was a 3-point deal, terrible rate, terrible everything. But that's how he presented the best deal for him, not for her. So their interests are unfortunately about getting paid. It's not relationship based. So avoid brokers. I'm sorry. I got like, of the 30 I work with, there are 5 that I love. And I'm just going to be real straight about that. I wish there was more transparency, but if you can go direct, go direct. Brokers are great if you work full time and you don't have time to find lending. If you're uber busy, you have tons of money and you don't care, go use a broker. They'll do all the work for you. But I think in our avenue here, we all can do the diligence and find the direct lenders.
Because you guys are going to learn so much from going through that process that don't miss out on the free education you're getting as part of going through that.
Yeah, yeah. Other things is there's ways to lower your points and your rates. It's not always going to fit with what you want. So if you want 80 to 85% on a purchase, you're not going to get a lower rate or lower points. If you want to go to 60% of that purchase, we can lower your rate for sure. So there's always, it depends on what you need, but there's options for that. It's just if you need everything, we can't give you, there's no way you can have the best leverage, the best points, the best pricing. It just doesn't work like that. Points can be lowered by different things. So if you want less points at the front, so you want to pay less fees when you close, your rate might go up a little bit. But if that's worth it to you, you could do that. You also can earn points by referrals. You can earn points. That's where you tell, people close a deal and you refer them. Your next deal will be no points. And then you can buy, like I said, you can buy out of points with a higher rate. Repeat business with a lender usually gets you better pricing. It just does. It's easier to do your deals. It's faster. We want to value you as a repeat customer. And you get better rates. You also get better trust. So like we'd be okay going into a riskier deal with somebody we know that has exited with us before versus somebody brand new who's like, I'm gonna experience this, that, and the other. And I go, why are you looking for a lender then? Because you should have a good lender if you're in that situation. So building a relationship and having that repeat business is benefits you as well. And I have customers that love me, will never leave me, and they'll go, Melissa, this other lender just offered me this. And I'm just like, let me try. And so I can go and like, say, Kristi just got this and how do I beat it? And then I can, finagle some better rates and try to like get better stuff for my repeats because we want to value them. We don't want people shopping around. So we do the best we can, but that holds us accountable because I can't just throw you garbage all the time. Like I still have to be competitive. I still have to earn your business. That's our job. So it's not a bother. Like, remember, like you have the power. And then draws and rehab, that's a whole other conversation, but they're easier than you think. And they're really useful, especially if you don't want to have all your liquidity tied up into a deal. But if somebody really wants to know about that, we can do a call.
Awesome. Cool. Did anyone have any other questions? I think we got most of them, and then we'll work on those three documents. We'll get back with that. And yep, there's your contact info too. And I dropped your email in the chat as well. So yeah.
Yeah.
Melissa,
and I'll get those docs over to Kristi and then she can get them out. And then, like I said, I love conversations, love due diligence deals. So it's never a bother. Feel free. I'll get you on our calendar and just help where I can.
Awesome. Cool. Well, thank you all. Well, like we said, we'll get out the replay. This goes in the vault. Seth, if you can bring up that QR code one more time, if you guys want to check out the blueprint course, like Lynn had mentioned a couple things with that. If you end up taking that one and you go, whoa, like that's how real estate development works. Like this is the foundation. I understand what's happening. And then you want to take the accelerator, you actually get the cost of the blueprint course taken off of the accelerator. So and then like we had said earlier, we are launching the community at some point in September. And we're probably going to put that on the school platform, and anyone who buys the blueprint is in there because we understand that even if you're interested, it's just like any other real estate community we're in where it's like, hey, I want to talk about flipping. I want to talk about house hacking. We want to talk about our development deals so we can get more information, so we can wrap our heads around how that could work. And the more you hear about other people's ideas and what they're doing, the more you'll start to see that old building or that vacant lot in your community and go, maybe I'm the person who can do that. So yeah, lots of exciting stuff here. Melissa, thank you so much for your time today. We'll get you connected with the people for some follow-up calls, and thank you all. We appreciate it.
Great. Thanks, guys. We'll talk soon.